Today we're here to talk about your tax obligations and how to prepare for your tax. With me is Graeme Price from Price Gibson. Graeme commenced his accounting career back in 1969, so a man with a lot of experience. Graeme, could you please kickstart?
In relation to property acquisitions, the first one is stamp duty on the acquisition. Moving forward from that is land tax, if it's applicable, then income tax, and potential further stamp duties on the resale of properties. Now, in relation to land tax, the current situation is that, we go back to stamp duty, is in relation to the acquisition, there's a 4% or thereabouts of the acquisition cost is stamp duty. However, from next year, the state government has announced that on commercial properties, there will be no stamp duty on acquisition. However,
but they certainly get you rights for the year.
On land tax on an annual basis.
Yep.
And then if you sell that property, there's still no stamp duty for the purchaser, but land tax will continue.
Yep.
Now, the rates of that land tax haven't been announced as yet, so we're unsure as to that.
And we're expecting that to be possibly a bit higher than 4%.
Correct. Yes. Now, in relation to land tax is an annual tax that commences from the 1st of January each year to the end of December that year. It is reviewed annually by the Valuer General for upgraded valuations, if you like, and then the applicable rates of land tax is applied to that valuation.
You know, I just want to jump in out there, Graeme. I love land tax. I'm not sure why I say I love land tax. You buy the property, you pay your stamp duty. You get your income, you pay income tax on your income. Then you pay land tax. Is that a triple whammy?
Well, from the government's perspective, it is a revenue raising measure, and as from the 1st of January next year, it's going to hit a lot of landlords significantly because they brought the exemption level down from 230,000 to 30,000. So there's going to be a lot of landlords who have never paid land tax.
Will be paying land tax now.
Paying land tax.
Yeah. From 230,000 down to 30,000.
Exemption level. So there's going to be a significant amount of small landlords that have been exempt from land tax up until now, but from the 1st of January will be hit.
So what does that mean? Does that mean that perhaps rents may start to go up?
Well, I think landlords will have to make commercial decisions because they have another added cost to their portfolio that needs to be either recouped or added on to the rental to recoup some of that. So there will be significant pressures on landlords as to whether commercially they can increase rents.
Especially considering that interest rates have gone up.
Correct.
So their repayments have gone up.
Correct.
And then now they pay the additional, or the tax that they weren't paying, now they're paying land tax as well.
Yeah. Which is a state tax. So that is going to have significant impact on landlords. And then, as I said, with the yearly revaluations that the Valuer General does, it's like a double whammy. First time you're in the system for land tax, but also each year there's a revaluation, generally upwards, way has been for the last few years.
So Graeme, in addition to all of that, what about income tax on investment properties?
Income tax on investment properties, the net rental income, that is after deductions for your interest and your land tax and your rates and
maintenance.
The net rental income is assessed depending on the structure of how the property has been acquired. If it's in a company, there's a 25% income tax rate. If it's been acquired by a partnership of individuals or trusts, it is then distributed down to the partners, and they pay tax on it, whatever their applicable tax rate is. If it's via a trust, a discretionary trust, the discretionary trust will distribute the income to the beneficiaries, and those beneficiaries will be assessed on their net income at their personal rates. So if the property is in a superannuation fund,
and there is a $20,000
in individuals, the first 20,000 thereabouts is tax-free.
Is tax-free.
And then incremental rates thereafter. If the property is in a superannuation fund, the net rental income is then assessed at 15% tax rate.
Yeah. Tell me something, Graeme. Is the land tax different percentages in different states?
Yes, there are. Yeah.
Which is the highest state?
Victoria.
Which is the cheapest?
I'm not sure of that one.
Gotcha. Graeme, now, apart from all of that, capital gains tax, this is an interesting one. How can you minimise your capital gains tax?
A capital gains tax, again, depending on the structure that you property owners purchase properties in. If it's in a company, the critical factor is that there's no discount, 50% discount on the sale of the property. So that is a significant disadvantage of putting properties in companies. If the properties are in individual names or discretionary trusts, the 50% discount, capital gains discount, is applicable. So
you buy a property for, hypothetically, for $5 million, you sell it for $6 million, 500,000 of that is exempt.
Exempt from...
The balance of the $500,000
is assessed at whatever rate is applicable to you. If it's an individual, the individual's tax rate, or if it's to buy a discretionary trust, again by the beneficiaries.
But if you sell that property for $6 million, but 5 years later, then every year you, apart from the $500,000 exemption, the other $500,000, you get a CPI every year?
No, not in. That was in the old days.
Okay.
No, it is purely what you sell, less your cost base. The profit is then assessed as taxable, and if it's in a trust or individuals, you get that 50% exemption.
That's it. You pay your percentage on the 50%. What percentage is that?
Again, depending on the individual's tax rate or the beneficiary's rate. If it's in a company, you'll pay your 25%. If it's in a superannuation fund, the applicable tax rate is 10% of the capital gain.
When you analyse all of this, one would virtually beg the question, what are the advantages of having an investment property? After all we've just discussed and what we've heard from Graeme, you wonder if there is an advantage, a tax advantage, capital gains advantage of owning an investment property. Would you like to add to that, Graeme?
Yeah, the tax advantages are purely on the capital growth of the property. The income tax, if you have a negative gearing property, that is your expenses exceed your income, you get a tax deduction or tax reduction because you're offsetting against other income. You need to compensate that with the rise in capital growth to offset that after-tax loss. So if you're buying properties with a huge upside or potential upside, you're going to absorb the net rental losses that you've incurred along the way. The capital gain will far exceed, even with the 50% discount.
Yeah. The upside that you're referring to is as in developing?
As in the value of that property, whether it's being refurbished and put...
Refurbished, raising rents in the event that you bought the property and the rents were much lower, had more potential to increase the rents, or alternatively, if you buy a property and you can build a multi-storey building out there, that upside, of course, can bring you greater returns.
Correct, and also the yields on the properties. If the yields move, so does the value of the property, and obviously the growth in those particular properties is the critical factor if you have a portfolio of properties. that you've got negatively geared, it's critical that the value continue to increase. Otherwise, you're not increasing values anywhere.
So Graeme, you touched on negative gearing. Can you expand further now?
Negative gearing is basically you have your rental income, whether it's a set rental per annum, but your expenses, including interest on the borrowings which you've associated with the purchase of the building, they exceed the income that's generated. So that net loss is then offset against the other income in whatever structure that you have the property acquired in. So a company, again, you would offset net loss against other income from other sources, or if it's in a partnership, it then is allocated to the partner's share, and they offset that against their other income that they've generated.
Are you finding that investors are still frequently negatively gearing their purchases?
When the interest rate...
Because a few years ago, negative gearing was a big thing.
Correct. And that would be... It's all to do with the interest rates.
Right.
When interest rates were quite low, as before the last 8 months, 10 months, the negative gearing wasn't so much an issue because the interest on their borrowings was so low.
Yep.
It has now turned the other way, where in the 22-23 tax year, which we're currently just finishing, that will be a significant increase in their net rental loss. But negative gearing has to be funded at the end of the day, and the banks are the ones that are pushing the interest rates up, which then forces interest repayments to increase. Now, if the rent can't compensate for that, they have to have other resources to manage that repayment program. So the negative gearing will, in 23, I think, be significant.
Will be surfacing again.
Correct. However, with the banks, whether they can continue to meet their repayments to the banks is going to be the issue. As far as positive gearing goes, it's quite the reverse. That is, you have no interest borrowings, or very little, and your net rental income is positive.
And then you've got to pay more tax.
Correct.
Yeah. And hence the reason why a lot of investors negatively gear.
Well, it is all done for design for capital growth. They're prepared to fund the net loss on the rental to be compensated by the value rising on the property itself.
In relation to what expenses an investor can claim, I think you touched on that earlier on. Maintenance, interest payments. What else can we cover off on that?
The one critical factor that a lot of investors, property investors, forget is if the property is acquired, they should have a mob called BMT. People will come in and assess the fit out, and also whether the building's of a new construction, because there's amortisation of new buildings at 2.5%. And if the fit out is in various forms, there's various depreciation rates applicable for different types of furniture.
So if you put in a new kitchen, for instance, you put a new kitchen in, you spend $60,000, $70,000 on a new kitchen. What's the depreciation you get on that?
Depending on the items within it, it'd be, average 7.5%.
Cabinetry, appliances. What's the depreciation on that?
It's around about 7.5%.
7.5%. Painting and all of that is 100%.
Yeah, if it's repainting, that's a maintenance issue.
Maintenance. So that's 100%.
Correct.
Yep.
Yeah. But the one critical factor is, certainly if you're buying a new building or a recently refurbished building, is the building amortisation costs, which is a separate component of your land and building when you buy. You really need to know what is the building costs. So the vendor should actually provide a schedule of the unamortised amounts of the building renovation costs, which can be significant.
What about tiles and carpeting and all that sort of stuff?
Yeah, that's...
and also what I would like you to highlight is the labour component. Would the labour component be 100% tax deductible as compared to the item itself?
No, they're added together. If that labour component is in installing the carpet, it's part of the capital cost.
So even with carpets and tiles and all that, you get the depreciation.
Correct.
And how much is the depreciation? That should be much higher.
The carpet is, I think, about 30%.
30%.
Yeah.
Okay, that's an interesting one.
If you buy a commercial property, or and it's been recently refurbished, as quite often in the city in particular, there is an element of the cost factor of that new building refurbishment.
So we bought this,
Yes.
and we spent, let's say, $400,000 fitting this
Yeah,
out.
that's the fit out, but I'm talking about the actual structural costs of the building itself. The people will give you an assessment of the building cost, and you can amortise that at 2.5% per annum, which is a separate item within the depreciation schedule.
Oh, I see. Okay, so looking at depreciation on the...
There's depreciation on the items we covered before, but the building cost itself, you know, and we use a particular mob called BMT depreciation people, and they will come in and assess the building cost and any other items that you may not have covered off on that you can depreciate and get a further tax deduction for. Some items that do get overlooked are the in the repair field. If you buy a property and you have a lot of initial repairs, people sometimes think that's a deductible cost straight away. Under the tax laws, if initial repairs are done straight after acquisition, that is not a capital. It's a capital cost, and you cannot amortise that or depreciate it or claim as an outright deduction.
So how long do you have to wait?
Well, normally it'd be 12 months before you can, like for arguments, carpet repairs or repainting or whatever. You need to have some period of time.
To show some fair wear and tear.
Correct, that's right. Some people do expect the accountants to prepare the tax return, say, I've spent all this money, I bought the property, I've spent all this money doing it up.
Reasonable to understand.
Yes,
You know?
but unfortunately you cannot claim that as an outright deduction.
Yeah. Especially these days, the amount of pressure on providing accommodation, even in offices at a certain standard,
Yes.
Investors are spending that sort of money.
Correct.
So then why wouldn't we be allowed to claim on some of that?
Well, you can claim it over a period of time, but not as an outright deduction.
Yeah.
That's the critical.
So the depreciation over a certain number of years,
Correct, yes.
until you get it down to zero.
Correct.
Yeah.
So you're not getting an outright deduction,
Yeah.
which a lot of clients we come across think that they are. We have to explain to them, well, if it's initial repairs, it's not permissible.
Initial repairs, outside of painting and stuff like that, which you get a full tax deduction on.
Yeah, but repainting, if you go into the office or the property that you first acquired, and you paint it out straight away, that's not deductible, because you haven't derived any rent as such, as what they term initial repairs. So you have to amortise that. If after 6 or 8 months you go in and repaint, there's a nexus between you've got tenants in there.
So if you buy a property and it's lying vacant at the time that you settle, and you then want to rent it out to someone, and it needs repainting in order for you to rent the property out, you repaint the property, you don't get a
not
deduction
an
for
outright
that?
deduction straight away.
Just why not? That doesn't make sense. Then you wonder why people just prefer to then just wait and claim it.
Correct.
Yeah. Graeme, how do investors best prepare for their tax returns, holding on to receipts, etc.?
My advice would be that the property agent should encourage their landlords for them to handle, that is the property agent, to handle all the expenses in relation to the property.
And then he gets a statement at the end of the year.
Correct, and the year end, there's an annual statement comes out which summarises the gross rent for the year, every commission for the property agent, less any expenses that they've
All the
paid out on
maintenance.
behalf. So it's all in one concise document, and the property or the tax agent is not listening, saying, "Where's this information? I'm missing that." Or
and that's an advantage to have an estate agent looking after your property.
correct.
Looking after it yourself, you may be saving that small amount of commission, and it's a small amount when you consider over 12 months' time, because that in itself is a tax deduction.
Correct.
But at least the estate agent is earning his keep by giving that end of year statement.
Correct. And for us as tax agent, if it's all in one concise document,
makes it easy for you.
Makes it easy for us. It's time saving, and we're not having to continually go back to the property owner saying, "You would have paid rates and taxes," for argument's sake. There would have been insurance. There would have been some repairs. That
and so your cost to the your client is less as well.
Correct.
How come I always pay the same amount?
Well looked after.
Sorry, what was the answer?
So that's the critical factor, because the more summary of the expenses in one document, the easier it is, and the quicker that you can get your tax refunds in, if that's applicable, on your negative gearing, for argument's sake, straight after year end. We've covered off on the building amortisation costs. That's a critical factor, but also is keeping records of any capital assets that are incurred post-acquisition costs, because that forms part of your cost base when you come to capital gains tax. Now, if you get a bit tardy in your record retention, for argument's sake, then come to when you sell the property, the cost base is lower than it should have been, and your profit is obviously higher, and you're paying tax on 50% if you're getting the discount. If all your capital costs are being recorded correctly, you will minimise the capital gain. So that's a critical factor in terms of capital gains tax, which can be quite staggering in terms of potential tax profits. In respect to property acquisitions, there's pros and cons in relation to whether you go residential properties or commercial industrial properties in terms of capital growth and rental returns and associated expenses where they can be recovered from the tenant. So your preference?
Well, my preference is, and it has been for a number of years now, perhaps around about the 25-year mark now, buying commercial properties. With residential properties, the tenant generally pays a bond. That's your security in case anything goes wrong with the maintenance of the property. Whereas a commercial property, they pay all the rates, apart from land tax, they pay all the rates. They tend to maintain the property a lot better because it's their business. Their business is being run from that. They often invest quite a bit of money to do a fit out in order to present their business. Now, when we talk about commercial properties, I would prefer to buy a retail shop or a retail space that has got some upside in development potential over buying a factory. When you buy factories, it's like buying an apartment, and I'll explain that in a minute. When you buy a factory, the factory sites are generally a lot older, whereas the new sites that come up, buyers get lost to that. So therefore, I prefer to buy retail shops. Settle on a good lease and forget about it, as compared to residential. Yeah. In my opinion, my advice to most investors is to stay away from investing in apartments, flats and apartments. And the reason for that is that when they're brand new, they look amazing. They look beautiful. All the common areas are looking fresh and clean. Whereas with an apartment, you can look after your apartment, but as soon as you walk outside the door, the hallways, the lift areas, whether it's the painting has been destroyed, whether it's chewing gum lying on the floors or whatever, the common areas start to look old and tired. Time comes for you to sell, you're up against all the brand new complexes that are coming up. Now they look fresh, sharp, clean, modern. Yours is looking tired. Like I said, you can look after your apartment, but you've got to get get the body corporate to agree with all the owners to upgrade the whole building, and that's often very difficult. Whereas if you have your own property, even if it's small, simple, in an area that's a lot cheaper, you can look after your property from the front fence to the back fence. And that's why I always recommend house and land as compared to flats and apartments. So Graeme, to summarise the whole tax matters, how would you end off?
My recommendation is that the property agent has a vital part to play in the tax return preparation for the landlord. If they can convince the as their tenants and the landlords to have everything going through their trust accounting area, they can collate the information all on one sheet for the tax agent at year end to assist in the preparation of the tax returns, and it's a very timely effect. That is, you get all the answers in one sheet. You can then process that information into their tax returns, whether it's company, individuals, and if it's negatively geared properties, generally that produces a tax refund. They can get their tax refunds quicker.
So there you have it. Land tax, obligations for investors to prepare their tax returns, commercial properties against residential. Thank you.